Hello and welcome to Money Matters. I'm Sarah Peterson here with Dean Greenberg and Dylan Greenberg of Greenberg Financial Group. You gentlemen look amazing today, as always.
And you do too.
Well, thank you. Thank you so much.
I know. You're a good fisherman.
Who, me? No. I always love being with you guys. You managed to make financial planning sound fun. To a lot of people, that's not the case, but you honestly do think it is. So that's why we love you.
Well, that's our favorite thing to do is talk about the financial plan.
100%.
It's become so intricate over the years. It used to be a different business, and nowadays it's just become, it's such an easy thing to do now with the technology that we have, and we've been able to.
Does it amaze you how many people don't have it? I mean, it's so easy, and how many people still don't have it?
Yeah, well, a lot of it, I think, becomes because of the fear of it. The main thing that we always see if they don't do it is because they've been putting it off because they're scared. Are we going to be good in retirement? Are we going to be able to retire when we want? Are we going to be able to have enough money? Are we going to outlive our money?
Or are you going to tell them to stop spending, maybe?
Yeah, sometimes you have to. We've had clients where we have to tell them to spend less money, or they're going to drain their accounts, and that's not what we want. But
then you
reality.
have some people who you say they can spend more.
Oh yeah, we definitely have people that's more often than not, people can spend more than they think in retirement. But it's that transition of the accumulation phase where they're saving their money through their working years and their 401ks and their IRAs, and now all of a sudden their paycheck's going to be coming from themselves, not from the company that they worked for 30 years. So it's a hard mindset to change.
I have so many friends who are retiring young. I think the stress is just getting to a lot of people. I mean, younger and younger. Again, it's like a generational thing. We were working really late, and now people are saying, hey, I'm 55. Like, I can do this, you know?
55, you said?
Yeah.
55,
I have friends, yeah.
Then they either done well, or they're going to live on less going forward.
Or they're going to get bored in 2 years and go back to work.
I know. I think it sounds great to a lot of people. Oh, yeah, I could be stay home and play golf and, cook.
Yeah, and I mean, it depends, too, what those people do. Sometimes we do have clients who retire in their 50s and never work again, but it's because they have a nice pension from a company that they work for their entire career.
But there's a huge emotional component to letting go of something that you've kind of worked your whole life for, or feeling sort of irrelevant, not having that clock every day waking you up to get up for a reason. There's a big
Well, you hit that right on the head. And I try to explain that to people. When you get older, if you lose your relevance, your purpose of getting up and doing stuff, you get old. If you don't have a hobby, if you don't have something to do, and I keep telling my wife and my family that as long as I have my senses, I want to be relevant. Now, I don't want to worry about operations on an everyday basis. That's why I have my team, and started teaching them how to do things. But relevance is very important. Giving back is very important. Mentoring is very important. But you have to know who you are. Why is this fun for us? It's because we're extroverts. We're not introverts. Can you imagine being an introvert and having to deal with people every day? We love it. We love meeting people, talking to them, helping them, And if you're a narcissist, that won't come across well either, because you got to be a giver. You got to be able to put yourself in the client's position and understand and hear them, and then solve their problem. We're problem solvers.
And I mean, that's the financial plan. We learn about the client. They come in brand new. We never met them before. We talk to them for about an hour, 2 hours, however long it takes. And we learn all about their life, about their journey, about their goals in retirement, their kids, their grandkids, anything like that. And obviously it revolves around the financial aspects of it, but it's a lot of your life. So we learn a lot about people really quickly, and it's very rewarding because a lot of people have a lot of cool stories.
I love that. And you're learning so much about the things that they did to get them to that point, which I'm sure relates to your other clients. I mean, it helps you kind of understand how people build wealth, how they truly build it. It's usually not because they're making a lot and spending a lot. They're saving it.
Yeah, a lot of it comes from the most successful clients we've seen through their working years are disciplined investors. They started their 401k early on in their career, which starting early, if you have grandkids out there, if you have kids out there, or if you are young, like under 40, start investing if you haven't already, because the power of compounding is huge. And time is your best friend. You can't get time back if you start investing late. Obviously, you should start investing right away if you haven't started yet. But if you're young, take advantage of it. Take advantage of the time. Start with little amounts, and then that'll gradually get bigger and bigger. And the next thing you know, the last couple compounding doubles that happen every 6, 7, 8 years will be huge when you retire.
I love talking to my kids. When that whole Starbucks theory came out, I was like, if you got a Starbucks every day and then you didn't get it, what that money could do in, 10 years and 20 years. they did not believe it. 100% were like, that is not true, because to them it's like, oh, what's a $5 coffee drink, or what is it, $7 coffee
that's a
drink?
great example.
Yeah, I don't even want to say, I'm dating myself, but but it's amazing if you have that leeway, that time span, what that could do for you, what your money can do.
Well, there's always a good example too. There's a story where you got two people. They're both 20 years old. One person A puts in, say, $5,000 a year for the next 10 years. They stop at age 30, never put in money again in their 401k. This other person doesn't start till age 30. Then they put in $5,000 a year up until age 60. Then they're both 60. Who do you think has more money in their retirement account?
This is a trick question. The one that started sooner.
Person A, because of the power of compounding.
I know, but you're looking
But a lot
at
of
me
people
like...
don't, because they're like, well, the person B put in for 30 years. But person A did it so much earlier that money that they put in when they were 20, 21 is doubling, is growing. It's been growing 10 years longer than they started. So if you have the time, it helps a lot.
But that being said, if you're just getting to this later in life, it's never too late. And I would really love to know if I'm approaching my retirement years, if I'm on the right track versus getting there and then having an oopsie moment.
Exactly. Yeah, it's never too late. We're talking about the advantages of starting early, but obviously it's never too late to do it. And they have different provisions, especially if you're working, you can save more. You're making more money most likely in your 50s and 60s before you retire. So you're able to save more, and they let the 401ks, the IRAs, you all have these catch-up provisions, they increase periodically, annually, and you can put more away. So they are ways to save more.
Do people ever have the fear that they don't have enough to come even talk to you? You know, that how do they feel they don't feel worthy?
Well, yeah, there's definitely the fear of that, because I don't know if it's so much a fear, but it's an idea. They say, okay, I don't have $1 million. I don't have 500,000. I don't even have 100. I don't think I can come talk to you yet. Let me get to that point yet. And that's where we were like, we don't have minimums for a reason. We have models that we built up through the years that allow us to invest any amount of money, and more cost effectively if it's a smaller amount, obviously, and then we can get more complex as they get bigger. But the idea is we have these models that you can just start investing, because what I was just saying is you just want to get going.
Yeah.
Because once you have your feet wet in the markets, you're more likely to keep doing it rather than waiting and the what ifs. And you can get more of a grasp on what's going on.
So if you're sitting on the sofa and you haven't had this conversation with your financial advisor, or you have an advisor and he's not prepared to get you through retirement, this is definitely a time to revisit that with a complimentary financial plan that could otherwise be costing you thousands of dollars. It's a way to find out if you're on the right track to getting to where you want to be to enjoy that special time of life. That phone number is 520-544-4909. We'll take a quick commercial break and we'll come back and talk more about your Money Matters.
When was the last time you saw your financial professional? Are you getting the most out of the strategy that was created for you? Although you've done a great job finding someone to help plan for your future, are you 100% sure that you were given the right strategy? We can help answer these questions and more with a complimentary second opinion evaluation. We will take a look at what you have in place and then help determine if you're well positioned to get the most out of your future retirement income. In the event that it is not, we can help by making suggestions and showing you how to get on the right path. You wouldn't get just one opinion when it comes to a major health decision, so why would you treat your most important financial decision with such disregard? Call today for your no-cost, no-obligation second opinion evaluation to see if you're getting the most out of your retirement income plan.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg and Dylan Greenberg, and we're talking about this crazy world we live in and how to navigate our own financial freedom going into retirement. And having a financial plan is a number one. So let's talk about this process, because when I hear financial plan, I'm thinking, okay, I have plans. I want to sit on a beach and drink a margarita. That's my plan.
Well, the process starts with them. The process starts with them realizing that, let me check this out. Let me see what this is about. I've heard about financial planning. How will it help me? You don't know until you go talk to someone. So what they do is they call us. We set an appointment. We send them a nice email telling them these are the things we need. We start putting a plan together, and they come in. And we sit down, and what does it take, about an hour, Dylan?
On average.
On the first meeting? Yeah. Get to know them, what their goals are, what they want. You kind of get a feel of how they like to invest. But it's a lot of getting to know each other and talking. And then you put the thing together, the plan, and you put it all together, and then I'll let Dylan tell you what goes from there in that secret room when they're there and I'm not in that room with them.
Oh, okay.
It's called the meeting room. It's called
It's our conference
Now you have
room.
our interest.
Made it sound all weird. We have our conference room and the reason we did this is because we have the laptop hooked up to a TV. So when we're meeting with our clients, we can show them everything real time, what we're looking at, instead of them just looking at the back of our computer and just believing what we're putting. We're showing it on the TV, and the plan gives you ways to show them real time, like how would this affect my plan? If I was more aggressive in investing, would this help? Would it not help? What about being more conservative? And then a big one is Social Security. It's always that question, is it going to be here when I retire? Is it going to stay there? Especially with people taking it now, they're saying, is it going to stay there? I don't know. Nobody knows, but we have the tool to show you what that would impact your plan, how that would. If
So with,
it was a
with
25%
each different
cut.
age that you choose to do it at, where that
Well, we
leads
have
you.
that too, the Social Security optimization tool, where it gives us an idea of what age through the numbers is the best time to take it for you. Obviously, that's one aspect of it, the economic side, and then the other aspect's emotional. Some people say, I'm retiring at 62, I'm never working again, I'm taking the money that I gave to the government, and they are going to give it to me. Other people say, okay, I'm going to retire at 62, I might get another job, I might go part-time, I don't know yet. So in that sense, you might want to wait till age 67 right now for full-time retirement, and your full retirement age, which is going to be 66 in 10 months, anywhere to 67. Because then if you take it before your full retirement age and you're working and you make above roughly $23,000, you're going to start getting penalized. And you'll take half of your Social Security back through taxes, so you don't want to take it. But if you're not going to pay anymore, or if you're not going to work anymore, then you might want to take it. And those are all different scenarios that we go through with our client in the time and see what their goals are. And that helps us learn about our client more.
Well, yeah, and like I've said before in other shows, I am so intimidated by that, Social Security website and the book is so, no one's reading that. No one knows where to start. So it's so valuable to have somebody who can give you those answers.
Yeah, and another nice one that we have is inflation. Is inflation going to be high forever? What will that do to my plan? If it goes back to 5% and stays there forever, how will that impact my plan that I'm trying to get income from now that I'm retired? So we can show them that and what the impact is. Or if they cut Social Security by 25%, inflation goes up by 5% and stays there, what will that do? All those different scenarios, all the little questions you have in your head constantly that you never really have answered, we have the tools to help answer those questions. And most of the time, probably 95+% of the time, it eases your mind because it's not as bad as you think.
What you hope is that most of those things don't happen.
I got a question for you. Have you looked at the Social Security site?
I mean, briefly with my mother, and I was like...
Oh, your mom, okay.
Yeah.
You already told everybody how old you are. Do you think, on the last show, I caught that. I didn't know. I thought you were a lot younger, but we'll go with what you said. Do you think you'll have Social Security when you get to 67, 68?
In all those years from now? I mean, it's doubtful, but...
Okay, this is my point. Everyone thinks they might not get it there, but they're all upset that we're trying to fix it. Oh, we're going to take it away. If we don't fix it, what you say at your age and people younger than you, it's going to come to fruition. It has to be fixed. So I'm tired of listening to people tell us we can't fix it or don't want to fix it. There's a solution. And it's not just taxing people that make more money just to pay for everyone. Then why get Social Security out at all? You know what I'm saying? Mm-hmm. So at the end of the day, your answer is correct. You're not sure. But that's like 20 some odd years away. You think about people that are 30 years away. So at the end of the day, you keep putting money in, and your husband keeps putting money in. If we don't fix it, you're right. It won't be there.
This next generation is way more worried about if they're ever going to be able to afford a house. They're looking so short term because they can't even think about if they're going to have Social Security.
But it goes
they can't
back to
even
that,
figure out
right?
where they're living yet.
Okay, but if we don't fix Social Security, who's going to pay you Social Security? The young people. They're going to be taxed more. Okay, they tax more. It's harder for them to live. If they don't have to pay into your Social Security and only their own, guess what? They're going to be in much better shape.
Mm-hmm.
Yeah, and I mean, we tell people, I've been told my whole life that don't expect to have Social Security when you retire. Mm-hmm. It was never supposed to last forever. It was put in place back in the 40s or the 30s just to help supplement people when they retired, but they weren't living 20, 30 years after retirement.
Yeah, it was probably till they get to 66 or something.
Yeah, about 10 years or so.
Yeah.
So it was a lot different back then when those came out. And I mean, now Social Security is insolvent. It is just, he's getting paid his Social Security. I'm paying into Social Security, but we have more people taking from it than putting into it. So eventually, yeah, it's going to go belly up in a sense that you don't know what's going to happen with this. So try and put your retirement into your own hands by investing in a Roth IRA, a traditional IRA, a 401k, Roth 401k. And the Roth part means that it's after tax money, it's post-tax. So it's put in, you never get taxed on it again. So all those gains you make at your Roth 401k until you retire are going to be tax-free when you take it out.
So awesome.
Which is a lot better than the traditional 401k, because if you have $1 million in both of them, in reality, your traditional 401k is going to be anywhere from $700,000 to $800,000 total. Your $1 million in your Roth 401k is going to be $1 million. So something that's become more popular among big corporations as well in the last few years. So if you do have that option, you want to invest in that.
Oh, 100%. And also when you get a 401k, I feel like they hand it to you and you have no idea what you're invested in or what's going on.
Yeah, I mean, and it's no fault of the companies. They're not able to tell the workers. Yeah. They're just, here you go, enroll in it, and then here's an idea of if you're in there. And that's why they have the target funds and everything like that, but they're never as aggressive as you should be. If you're young, you want to be aggressive because you got time on your side. You have time to weather the storm. You have time. If you were 21 and you just started in the workforce back in 2000, right before that dot-com bubble, you would have weathered the storm of that 3 years down market, then 2008, then 2020, and 2018, that December,
Just
22.
felt so bad for all those people retiring in 2008.
Terrible timing.
Terrible.
But you can take advantage of when you have more.
What's going to happen out of all this? We're changing education, giving them back to the states. Maybe we'll get some financial literacy classes starting in high school and in college and make sure that people understand what to do. Because if you just keep doing the same thing over and over again, and then you become a parent, you don't know what to do, and then you have children and they don't have parents that know what to do, it just keeps evolving. How about stopping that and start educating?
Well,
so people know.
All the classes that are now missing in their education, all the classes that we loved the most and learned the most from, like home economics, like they don't have that anymore.
I didn't have that.
I actually learned how to sew in economics.
You learn that, and
Yeah,
you
the
learn
sewing
you can
machine.
cook, and I mean, but these are practical things. Like, I mean, yeah, so I mean, yes, you can do those things in the home, but I wonder why they took out everything that was practical, and then my kids are doing like super complex algebra that they'll probably never ever revisit again. And I'm like, but yeah, you don't know how to fry an egg.
How about geography?
Yeah.
Kids don't know the difference between a country, a state, a city. They don't know what states are around each other. They don't know what country. They don't know what country is south of Tucson.
You should start a geography class on TikTok. It would go viral.
Yes.
Everybody would know everything.
There you go.
Where the news comes from. The reality is that this is a good point, though. Look at all the different sources of media we're getting right now. We're learning from all different directions, and most of it's misinformation. So we need to bring it back to what we do know and the truths that we can plan with, because other than that, it's just creating this fear factor, like you were saying, and it's not healthy.
Yeah, exactly. And it's really just, you got to figure out what's going on in your situation. And then all the outside noise that you think is affecting you might not be affecting you as much.
Which is why whoever's listening on the other side of this screen needs to understand that if you don't have a financial plan for retirement, if you've never had these conversations, this is the time to do it, because we can't tell you how to invest your money. We can't tell you what to do until we know everything about you. We know the whole plan that's individualized for you. And that's what I love about this. It's not some cookie cutter thing. This is something personalized to you. So we're going to take a quick commercial break, and we'll come back and talk more about Your Money Matters. We'll see you in a few.
This is Money Matters with Dean Greenberg of the Greenberg Financial Group. I'm Spike Spangle. Dean, what really got you started in this industry?
It was because I was working for Ford Motor Company. I had ordered all the dealerships, and I kind of looked at things and I said, this is not what I want. So I went back and got my MBA in finance and investments and said, I'm going to work on Wall Street. I didn't really know the journey I was going to have until later on, 1987, when the market crashed.
Yeah. Black Monday.
Black Monday. The only person in a company of 600 and some odd brokers. I was buying IBM, and I opened a $500,000 account. So they say to me, hey, this is unbelievable. How did you do this? What did you do? I just said, because I thought it was the right thing to do. Down 20%, it was probably a good time to buy, and I was more of a technician and an advisor and an educator at that time. Long story short, they tell me a week later I never owned the stock. The back offices back then could not handle 1 billion shares a day. So a week and a half later, they tell me I don't own it, and I needed to call a client to tell them they didn't own the stock. And I told them that they should pay the client. Next day I came in, my box of stuff was in there, and they told me I was fired. And I went to go see the guy I knew to go get a job. And he said, Dean, I'd hire you tomorrow, but you need to start your own business. I laughed at him and said, how am I going to start my own business? I only have $5,000. He said, figure it out. We're all salesmen. You educate. You care about the markets. You care about your clients. So I guess I figured it out.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg and Dylan Greenberg, and we're talking about the importance of a financial plan. And what I want to know is, as you approach retirement and you get closer to that stage and you're sort of taking risk off, like how do you find that balance? Because I know when you're younger, you're so aggressively wanting to invest and make money, but then you got to kind of pull back a little on that.
Yeah, like I was talking about last segment, how when you're younger you can weather the storms, but then you mentioned, I would hate to retire in 2000 because then all of a sudden you're living on that, your money. You got to be more conservative, and in that sense, you got to be less in the stock market, the equity market, and buy more bonds. That's the bond market. The bond market is supposed to be the more stable market. It's a lot bigger than the stock market. It has bonds you can buy from individual companies, from the U.S. Treasury, which is the safest investment you can do. As long as it can be. It is AAA rated, and that's just the best it can be. And then, so what it means is you buy an individual bond, you hold it to maturity, you get your money back plus interest. Obviously, the safer the bond is, the less interest rate you get on it, but you're not looking for so much growth anymore. You're looking for stability. And a lot of people that we work with who retire and start needing to live on their retirement accounts, we buy the individual bonds for a bond ladder, which is, say you buy a 1-year bond, and then a bond that matures in 2 years, 3 years, 4 years, and 5 years. Okay. So we know that if markets tend to go down 1 out of every 4 years or so on average, during that year we don't have to sell equity side, the stock market side, to raise cash to send to you for your paycheck that you're taking from your account. We have it ready already in individual bonds, and that have matured through the safety and the stability side of it. And those are different than a bond ETF. A lot of companies use bond ETFs. The issue you run into with a bond ETF is that you can lose your principal. Like in 2022, the stock market went down roughly 22%. The bond market went down 26%.
Wow.
Because you're losing because interest rates just went up. So then the value of the bonds that are held within the bond ETF went down a lot. So then all of a sudden, your principal, you put in $100 in that bond ETF, is down 30%. You have $70 now. But you don't necessarily get that money back. If you held this individual bond to maturity, say you bought a 1-year bond, and you have it could be down because interest rate go up, so the value of the bond goes down during that time. But if you hold it to maturity, you'll get your principal back. You'll get your $100 back in the bond, and then you'll get your interest on top of it. So individual bonds are a little more stable, a little more safe if you buy the good companies or you buy the U.S. Treasury. Obviously, if you hear the word junk bond, the likelihood of them paying are a lot less, but you get a higher interest rate. So there is risk in the bond market, but it's supposed to be stable, more stable, and that's one that you want to look to reallocate your account as you get closer to retirement. You want to be able to have roughly the old age thing is 60-40, 60% in equities, 40% in the bond market. But there's a lot of different ways to get that allocation.
And do you change it when things are feeling like current
doubt.
economic climate just seems a little...
Well, that's what's the difference. One of the things that we do the financial plan, but we also manage the money. We started in this business in '88 when I came to Tucson as a money manager. And I put myself on the other side of the desk and said, what do I want as a client? And built my whole company around the same things I want as a client that we could deliver as a firm. And as we've grown, we've kind of grown now into a family office. And I don't mean just family because of father-son. I'm talking about family offices that are able to offer financial planning, risk assessment, insurances. We're able to give, we're also able to do estate planning. We have an attorney in the office. We'd have accounting associations in the office with people. And we're able to grow. So you come to us, we're all working towards what you need as a person, and we all know you. So you don't have to jump around to different things if you don't need to. So we have everything under one roof. We handle, obviously, the money management, the financial planning, and the risk assessments.
Yeah, but this way you know who's dealing with my, say, estate planning and different things, and so you guys can work together, and it feels like everyone's on the same page.
Well, they have to have the same idea. We do. Client comes first. Okay, give them a great value. Work with them, answer their questions, do the things that you need to do, and customer service. There's nothing that you can do to tell me that customer service shouldn't come first. It costs you nothing to have customer service. Just answer the phone, talk to the people, deal with them, get their question answered. Don't delay. That's customer service. If you do that, people are shocked today.
Yeah, I mean, another thing of customer service is helping people too, and that's why we always, with this financial plan, it's free. You don't get charged anything unless you open an account with us to invest with us, and then it's the whole fee structure. But leading up to that, if you want the financial plan, we help you with it. We give it to you as after the meeting, and then if you never want to talk to us again, you never have to. But it's the idea of helping people and helping things, and that's why we want to make it free. We're not there to make it a burden to do it or scare people to come in, or it's a lot of money. We just want to help people.
Well, it goes along with your team approach and your education, your radio shows, and all the things you guys do, your television, giving people the education that I don't know where else you get an education like that, unless they do bring it back into the schools.
And more than any of that, just education. Sure, we have all the education and all license and all that stuff, but guess what? We've got a lot of experience. I've been doing this a long time. Okay, should you lease a car? Should you buy a car? What's the best way to get your mortgage out on the house? We'll help all our clients with that without getting paid for that. That's part of what we do as our services as a family office to help people. Okay, we get paid with the money that we invest for you. Okay, better you do, the better we do. The worse you do, the less we get. Okay, it's a fee, all fee business. That's what we are. We're fee business.
Well, and we talked about this with the Trump presidency, but transparency is key right now. I think everyone's just so leery about not knowing what's really true or not, and so being transparent with people and talking to them straight like you guys do, and giving them just really what everyone's looking for is just the answers.
So there's one thing left to do, and what is that, Sarah? Pick up the phone.
Oh, I was going to say go get a cup of coffee. You have coffee. You told me you have coffee.
We do. I don't drink coffee, so I don't know how good it is. Everyone says it's great.
Good stuff. I like coffee.
Thank you so much for taking the time to be with us. We hope that we educated you in a way that is so difficult to get these days. This phone number is 520-544-4909. Give Dean and Dylan a call, and this is a completely complimentary for taking the time to be with us. So we hope to see you next time on Your Money Matters.